Hello everyone. Assalamualaikum warahmatullahi wabarakatuh. Good evening everyone. Today we are going to discuss the chapter 8 about short-term financial planning by me. My name is Ananta Abimanyu, student from International Business Management in year 2020. First, the honorable to our lecturer Mr. Muslimin SEMSI and to all my beloved friends that I honored. So, in this chapter, we are going to discuss in the study of small business financial management from books The Small Business Controller. Going to the next slide. Short-term financial planning. In this chapter, as noted previously, a company can have profitable operations and still be unable to pay its obligation in a timely manner. A major change in the working capital items like current assets or current liabilities of the business may create this situation. And in this chapter, we are going to more focus on short-term financial planning, including like managing accounts payable vendors, or we can differentiate any type of company and maybe any agreements like commitment agreement or certificate insurance. In the next slide. There is two important aspects in this chapter. The first one is the need of additional working capital. As a company grows and increases its sales volume, chances are the balance in accounts receivable, like inventory in accounts, also the payable increase. Even though inventory is increasing, the vendors still need to provide trade credit, like still expect payment, and they have to pay it on time because within or not with the discount period if it's applicable on their agreement before. So the first important aspects is we have to know that we are really need additional working capital. Like we discussed before, the following regarding some of the important aspect is pertaining to accounts payable. Next one. The second important aspect is the managing accounts payable. For many small businesses, one of the primary sources of short-term financing is trade credit from vendors. We all know that when a company is monitoring cash management or maybe they're reviewing the relationship with their vendor, is a need to manage the accounts payable. And to help that, a new controller is made to understand the relationship between the purchases and the accounts payable function. A financial analysis is need to be prepared to obtain key relationships and ratios. And the example is on the books. We can look in the table 8, extract 1, and I didn't present it here because we can look in our each book. Next, different types of company commitment agreements. Like we know before, there is some types in company commitment agreement because the business's expertise control or processes, they need to be involved in the agreement signed by the organization, and some of the agreement may require disclosure as part of external financial statement, or just as importantly, the agreements may also require the organization to perform in some way or affect the agreements with other major creditor and vendor. There are 5 agreements that we are going to learn here, but before we go into that agreement, we can look back into the vendors. The A, B, and C vendors. In this chapter, we are going to learn about the example of the 3 vendors like this. First is the A vendor. The A vendor are the suppliers, usually only a few, who account for approximately about 80%, and the account is made for all inventory purchases. So in these 8 vendors, the items is usually have the faster turnover rate because it is really important that this quantity is beyond their hand. Next one is the B vendors. B vendors is usually provided by approximately about 10% to 15% of the inventory, and the items are less critical than those obtained from A vendors. However, we know that the communication process should still be quite active. Nothing less than annual reviews of B vendor contract should be occurred. And the last one is the C vendors. In the C vendors, we know that there is A and B before, but also these vendors are more numerous than A and B vendors. They usually account for a very small percentage. It is about 5 to 10% of the total purchases. And the communication process usually occurs when need or when the problems are arising in the company. So we go into the next slide that we talked before about the differentiate of company and commitment agreements. So the first agreement is certificate of insurance. The certificate of insurance usually major vendors require evidence of the amount and type of insurance coverage carried by the small business. In some cases, the vendor may ask to be an additional insured on the policy. Avoid this request whenever possible because it often requires additional insurance coverage that translate into additional exposure, as well as additional insurance premiums. Currently, the business insurance carrier can provide the request necessary information. The next agreement, the uniform sales and the use tax exemption certificate. Each seller and purchaser of merchandise must comply with individual state of requirement regarding the collection or exemption from collection of sales and use taxes. The vendor must collect the tax for the state in which they deliver the inventory. If there is no exemption certificate provided, a common reason for the exemption from paying sales and use taxes includes using the inventory for wholesale resale, or component for producing a new resold product, and the requirements in each state are different, and the controller should review in each jurisdiction. Next agreements, the volume purchase guarantees. When dealing with one or two major vendors for the purchase of a major portion in their inventory, an agreement may be required to specify a minimum volume over a specific period to justify the price concession. In other terms, the controller should ascertain over what period of time, like a monthly, quarterly, or etc., and encompasses, we have to monitor it and also review what penalties or other fees, if any, may arise because of the non-performance. As noted previously, in some cases, the purchase guarantees may require disclosure as part of the external financial statement. The next guarantee. The next agreement is the Universal Commercial Trade. The Universal Commercial Code, or we can call it the UCC. The UCC security agreements is a type of agreement that establishes a secure interest in some type of personal property. Like the meaning is when we are going to the inventory in these cases. Usually with no secure interest, the vendor has only the borrower's oral promise to pay for the inventory. However, with this type of security agreements, the business is giving an interest in the inventory to the vendor until the inventory is going to be paid. Last one is the inventory return and the restocking charges. And occasionally, business may experience and slow-moving or obsolete inventory items. In some vendors have very specific policies regarding allowing a customer to return merchandise and to receive a credit. In other times, the customer may have to negotiate terms. The restocking charge or both. In some cases, the restocking charge can be 10 to 15% of the inventory value returned from the credit. The controller should be familiar with the agreement and the terms is ascertain the advantage to return merchandise in the vendor in spite of the restocking or any other charges. I think that is all the material from the chapter 8. In this chapter, we are discuss short-term financial planning, including the need for additional working capital, and also discuss about the security agreements and the some of the guarantees, as well as commitment agreements and certificate of insurance. And in the next chapter, in chapter 9, a chance to discussion of property, plant, and equipment. And this include in small business controller in capital investment decisions. So that is all from my presentation about the chapter 8. Thank you for your attention. Assalamualaikum warahmatullahi wabarakatuh. Have a great day, Chan.